Hi, it's Paul Meredith, mortgage broker with the Paul Meredith team at CityCan Financial and author of the Amazon #1 best-selling book, Beat the Bank: How to Win the Mortgage Game in Canada. Today we're going to be talking about the effect of mortgage rates, of higher mortgage rates at renewal, how that affects you. We're also going to talk a little bit about how you can lower your payment, because higher mortgage rates definitely means higher payments, but there are things that you can do to bring that payment down if it becomes a little bit unmanageable for you. Now, mortgage rates continue to rise. Upward pressure on fixed mortgage rates continues to be severe. Just when you think that they start leveling off, or just when we think that they start leveling off, upward pressure resumes and rates continue to rise. So we had one lender increase rates this morning. We've had other lenders increase their rates earlier in the week, some last week, and it looks like there's going to be more fixed rate increases to come. Now, fixed mortgage rates can, where the Bank of Canada has 8 set announcements in which they will advise as to whether they are changing their rate, keeping it the same, dropping it. I don't think we're going to see a drop anytime soon. And the next scheduled rate announcement from the Bank of Canada is in September, where it's very possible that we could see another 0.25% increase again. Let's hope we don't, but it's possible that we could see that again. But fixed mortgage rates are more influenced by bond yields. That's one of the key influencers, and they have continuing to rise. They were up over 2% today again, last time I checked. So that continues to put upward pressure on rates. Rates are about as high as they were now back in 2007. So we're at about a 16-year high. And if the bond yields continue to rise as they have been, they do not seem to be letting up. That 2007 could soon be 2001. So we're going to have to wait and see what happens. I'm hoping that they settle down. We all are, but time will tell. And of course, anything can happen. Now, if you got a mortgage, if you took a 5-year fixed mortgage back in 2018, and if you got it through us, you were probably paying somewhere between 2.89 and 3.14. Now, today, 5-year fixed rates range from as low as 5.14 in some situations to as high as 4.84, or in some cases even a little bit higher. So that's quite a spread. It really depends on your specific situation. We could quote 4 different people, 4 different 5-year fixed rates, and every single one is getting the absolute lowest rate possible. Really depends on your specific situation. Now, with rising rates, of course, higher rates means higher payments. So that can have a significant impact, of course, on your payment if you have a mortgage coming up for renewal. So let's say, for example, you are coming off a 5-year fixed mortgage. You had 2.99%. Let's say your original mortgage was $650,000. You just maintained monthly payments all the way through. You did not make any additional payments. Your payment on that mortgage would have been $3,072.76. The ending balance, again, assuming no extra payments, just regular monthly payments, ending balance on that mortgage would have been $555,478.13. So if you were eligible for let's say 5.24% at renewal, your new monthly payment, again, the original monthly payment would have been $3,072. The new one is going to be $3,722, which is roughly $650 more than what you were paying before. Now, that obviously has quite an impact on your cash flow. $650 a month is a pretty decent car payment for some. So it does definitely have an effect on cash flow. Now, for most people, it is manageable for them. While not fun, it's manageable, not going to put them into a severe or dire financial situation, but it's just not fun having to pay this much more. Now, other people, they may find it a lot tougher than that. They may find that they're struggling to make the payment. Some people have Some people go on mat leave, they're on more limited income. Other people may have started businesses that are getting off the ground. So if you're in a situation where you are struggling to make the higher payment and you're worried and you're concerned about where that next payment might be, then there are some ways to lower your payment. One of them is to refinance back up to 30 years. One of them is to refinance back up to 30 years, which will lower your payment. Now, refinancing at 30 years, sorry, we just had a bit of a cutout there because we had a call coming in, so hopefully everybody is still here with us and you can still hear me okay. Looks like we're back there restored now. So if we go back up to 30 years, yeah, you're going to have a higher rate, but because you're extending that over a longer period, that is going to lower your payment. Now, and that's going to make things a lot more manageable. So let's say, for example, you have 20 years remaining on your amortization, you've got a mortgage balance of $700,000, and you have your options are a 3-year fixed at 5.84, which is available for some situations today. Your new monthly payment on that particular mortgage would be $4,922.66. Now, the lowest 3-year fixed available for a refinance right now is 6.14%, about 0.3% higher. Now, your new payment on that refinance, if we bring the amortization back up to 30 years, drops to $4,225.20. So a difference of $697.46. A pretty significant drop in your monthly payment. Therefore, that's going to make things a lot more manageable for you and should make life a little bit easier. Now, even if the rate, and that's 0.3%, now even if the rate was 0.5% higher, let's say 6.34% was the lowest, your payment is still going to be $609 lower than what it would have been if you had gone with that lower 5.84 rate and continued on with your 20-year amortization. Now, yes, you are going to be paying more interest here because some people might ask, well, am I paying more interest? And yes, you are. You will be paying more interest. But this is not about saving the most money here over time. It's about keeping as much money as possible in your pocket over time, at least for the term until rates start to come back down again. So it's just about managing cash flow and making life a little bit easier for you. So yeah, you're going to pay more interest, but you are going to lower your payment substantially. So that's one way of doing it. Another way, let's say you're in the middle of your term and you're looking for ways to lower your payment. Let's say you're making accelerated biweekly or accelerated weekly payments. Get out of the accelerated, contact your lender, tell them you want to convert to non-accelerated or monthly payments. That alone is going to increase your cash flow, because when you're doing accelerated payments, either biweekly or weekly, it works out to making one additional monthly payment per year that goes directly towards your principal. Now, if you remove that acceleration, then you no longer have to make that equivalent of one extra monthly payment per year, which should increase your cash flow by a few $100s a month. Of course, depending on how big or small your mortgage is, the overall size, it will vary, but for most, it does have quite an impact. Again, it's equivalent of one monthly payment per year that you are now saving, you're keeping in your pocket. So that's another thing you can do. If you're in a variable rate right now, chances are that you are paying a lot more than what you could get if you were to convert to a fixed rate. Now, I'm not saying those in variable rates should convert to a fixed. This is a completely different topic and a completely different video, which I have addressed before and I will address again in the future. So it really depends on the person. If you're in a variable rate and you are struggling to make your next mortgage payment, then you may want to consider locking into a fixed to bring that payment down, to make things a little bit more manageable for you. So that's a couple of ways that you can lower your payment if you need to. If you have a mortgage coming up for renewal and you are concerned about qualifying because rates are a lot higher now, which means people are qualifying for a lot less. We talk to people every day who are surprised at how much lower, how much less they're qualifying for than what they would have before. It's because rates are a lot higher. Everybody's qualifying for a lot less these days. But if you have a mortgage coming up for renewal, you do not need to worry about qualifying, because you can always renew with your current lender. You're already approved with them. You don't need to re-qualify with them. You just need to sign the form, send it back to them, and you're done. Now, unfortunately, that will likely result in you paying more than what you need to, because when your mortgage comes up for renewal, there's opportunity to save you money here. Different lenders come out with different rate promos at any time, and we can often save you money by switching you to a different lender at renewal, sometimes thousands of dollars. So you're going to want to reach out to us to find out what you're going to be eligible for, find out the lowest rate you're going to be eligible for, reach out to your current lender, find out what they're going to offer you at renewal, and then we'll see what we can do to save you money, and we will advise you if it makes sense to stay with your current lender, or if it makes sense to move on to a different lender and save yourself thousands over the next term. So if anybody has any questions, you can reach out to us. You can email us at pmteam@citycan.com. You can check out our website at www.easy123mortgage.ca. Now, I do these Instagram live videos every Thursday at 12 noon. I try to provide as much valuable advice as I can. So if anybody has any ideas for content on future videos, send us a message through Instagram, shoot us an email at pmteam@citycan.com, and we'll see what we can do to accommodate the request. Hope everybody found this informative and helpful. Hope to see everybody here again next week. Have a great day and have a great long weekend ahead.